Good morning, everybody. Happy Saturday. I want to get you a quick mortgage market update and talk a little bit about the big gains in the bond market that happened last week, what it did for interest rates, what caused it, and what it means moving forward. Let's jump right in. Okay, so what happened? We had the CPI report, the Fed's favorite measure of inflation, come in showing lower inflation year over year for the first time in many, many months. As I've said previously, inflation is the arch nemesis of the bond market and interest rates. So anytime we see inflation coming in lower, it is going to be positive for the market. So I'm going to show you the market on Thursday when this report was released. You can see that big green bar. That is a raise of about 200 basis points in the bond market, which provided some pretty solid relief to interest rates, which is why they were a little bit lower on Thursday and heading into the weekend. So what does this mean for our clients right now? I think this is a good time to just basically check in with everybody. So if you have clients out shopping, let's get them an updated mortgage coach with a total cost analysis and show where rates are and have a conversation. And maybe that helps them as they're out shopping, or at the very least gives them a much needed confidence boost. If you have clients that are maybe making offers this week, now is an excellent time to update their pre-approval letters and just give them the good news and help them as they're out shopping. And most importantly, if you have clients that are in contract, there is potential to renegotiate their rate and maybe get them a little bit of relief right now and sort of be a hero for them. So for example, I had some clients that were locked in at 7.375 and we were able to renegotiate them down to 7%. Now that's going to save them like $75, $80 a month on their monthly payment. So that's real tangible relief. And I'm not saying there's not going to be more volatility, and we'll get into that, but I think the big boost in the bond market means you should be connecting with your loan officer to connect with your clients and chat with them a little bit about what's going on, what it means, and see if there's any way we can help right now. All right, so let's talk a little bit about what this means moving forward and what caused it. So I'm going to pull up another slide. This is the CPI from June 2021 through today. And as I said, this is measured year over year into the past. It's a lagging indicator, which means it's showing long-term trends rather than trying to project into the future. So those yellow months, back in the spring, I was talking about this report and saying that it was going to get hard in the summer because we have low inflation readings. And so those year over year from early summer in 2022 readings are measured against these really low 2021 readings in the summer of 0.3 in July, 0.2 in August, 0.3 in September. So when the Fed pulls the CPI to look at it, it's going to look like inflation is high because it's such a low bar, such low inflation readings in 2020 of last year. I've been waiting for November so that we could measure the October 2021 reading for a long time because it seemed logical. All the indicators were there, all the market data to say that with Fed rate hikes starting to work and bring down inflation and that higher 0.6% reading in October 2021 of the CPI, there is a really good chance that we could have lower inflation readings year over year. And sure enough, that happened. You've got on the far right of this graph, 0.3% inflation reading of the CPI in October of this year measured against 0.6% in October of 2021. That's a 0.3% decrease. So that's the first decrease we've seen since, June of last year, so what does this mean moving forward? We've got several more months of those peak ratings in 2021, November, December, January. So we should continue to see this trend playing out where we've got lower numbers. And it's not just because the reading year over year, it's also because we have had the Fed hiking rates for many months now and doing the work to bring inflation down. So action now and a higher inflation reading to read against from last year, we should continue to see this trend. And it should continue even further once you get into the February and March when inflation is lower in 2021 because inflation is going to be dampened by the Fed continuing to do this work and put the pedal on the gas and make sure that inflation comes down. So I know everyone's curious about rates. I would say that it wouldn't be out of the question to see rates come into the 5% arena in the early part of next year if we see these trends continue on, which we think we will, which, we've been planning this since the beginning of 2021, talking about it, and it's playing out. So that's kind of what I think. I'm happy to chat more about that in person. The bottom line here is that the modeling is working. We are moving into a recessionary market. There's plenty of other indicators that are showing this, such as continuing unemployment claims on the rise, layoffs from large companies like Meta, things like that. And as we move into a recessionary market, we know that's going to benefit mortgage rates in the housing market because inflation will come down and that will bring rates down. So we're doing the right things. 2-1 buy downs, having these conversations with clients, helping people to be educated so that they can have confidence. And I want to keep hammering that. And I've got some resources below about some 2-1 buy down flyers that I've been putting at listings with custom scenarios. I'm happy to make those up for anybody that's interested. And the other thing to remember is that we are going to head into a market where there's tight inventory and people are now hibernating for the winter. So if we do see rates start to come down to the 5% range, we're going to unleash a whole slew of buyers into a tight market. So the modeling is working again. It's going to be a bumpy road, but good things are coming when rates start to come down. So I think we just need to keep getting the word out and stay optimistic and talk to our clients and educate. So happy to help. Have a great weekend. Thanks very much. Bye.